invested, these companies delivered £100 back to investors. And we want to look at what lessons these previous 100 baggers can teach us about trying to find the next ones. And hopefully we can all go on and to find our own 100 baggers, because life gets pretty good if we get 100 baggers. So this talk has 4 parts. First of all, I'm going to quickly go over about what buying a stock actually is and what it means. Then I'm going to briefly talk about the mechanics of a 100 bagger. Then I'll go over the 100 bagger studies, the previous studies of these 100 baggers, and look at what lessons they can teach us. And then finally, we're going to look at how, maybe some examples of how we can construct portfolios to hold on to these 100 baggers. Okay, so before we start, I want us to play, or to use our imagination here. And I want you to imagine that all of your family's wealth is taken away from them. And in return, I give you £1 million. Now with this £1 million, you need to invest it into a business that's going to support and protect your family's future. So I come to you with a business and say, I've got a business for sale. Think, great, I'm looking to buy a business. Tell me something about your business. What products does it do? And importantly, what price are you going to sell me that business? And I'm going to tell you, no, none of that matters. All that matters is this company's earnings, next quarter's earnings, are going to be more than last quarter's earnings. And you're most likely to say, but you haven't told me anything about the business. You know, I'm meant to put my family's wealth into this, and you haven't told me what products it does or what price you're selling me. And I'll tell you, no, none of that matters. All that matters is next quarter's earnings are going to be more than last quarter's earnings. Now, I don't think many of you are going to want to put your family's wealth into this type of business. But you might be surprised to learn that billions of pounds are invested this way every single day. And it has many names, but one of which is momentum investing. Yet again, I'm going to come to you with a different business this time. And I'm going to show you a pretty little chart. And it's got 2 little lines that are crossing. And I'll tell you that when these 2 lines have crossed in the past, it's been a good time to buy the business that underlies this chart. And you might naturally say, you haven't told me anything about the business. You didn't tell me what products it does, it sells, what services it has, and you didn't tell me what price you're selling me this business for. And I'll say none of that matters. All that matters is that these 2 little lines crossed, and when this happened in the past, it's been a great time to buy the business. And yet again, I don't think many of you are going to put your family's wealth into this business. Yet again, billions of pounds are invested this way every single day, and it's called technical analysis. And I could go on and on about different businesses, factor investing or macro investing, but the fundamental truth is that most people's idea of investing in the stock market is completely divorced from the reality that buying a stock is buying a partial ownership in a business. Now, I want to show you a quick little video just to sort of hit this point home that they're putting into businesses, and they can't even tell you what the company does. And this is really the truth, is that investors today treat the stock market as if it's a casino, rather than treating it as a place to go and buy businesses that can compound your wealth over time. This is a shocking statistic that now the average holding period is 0.6% of a year, about 7 months. I mean, think about this. Businesses grow and evolve over time slowly, and yet we're trading them every 7 months. Think about this if we did this with any of our other assets. If we did this with our house, you'd think I was crazy flipping in and out of houses every 7 months. Even if I did it with a car, buying and selling cars. And the truth is that people view the stock market as a casino, and they're trading businesses that compound wealth as if they're Pokemon cards. So as investors, we need to think about business. When we're buying a stock, we're buying the partial ownership of a business. And we want to buy that business for less than it's worth. So we need to value a business, and we need to buy that business for less than we think it's worth. So is the absolute value. We can ask, if we were to rent out this house, what are the cash flows that are going to come from this house? And what are we willing to pay for those cash flows? So if we could rent out this house for £1,000 a month, £12,000 a year, what are we going to pay for that? And that's totally up to each individual. And some of the questions we might ask is cash flow going to grow or shrink over time? How does the cash flow from this house compare to all the other houses that I could buy and rent out? And then we can start asking questions like this, and it's exactly the same with the business. With any business, we can compare it to the competitors in the industry. We can look at what the cash flows from that business are likely going to be, and we can decide what we want to pay for those cash flows. What you'll notice is whenever you're buying a house, we don't use any complicated formulas, we don't use any Greek letters, and we don't use any of this bullshit. And so really, it's the same with the business. Valuing a business is not very complicated. It's the same as valuing any other cash generating asset. So now that we've sort of got an idea of what buying a share is and how we might value a company, let's talk about how we can get 100 bagger. And this is a stock that goes from 1 to 100, delivers shareholders 100 times their money. And I want to preface this talk, there's nothing magic about the number 100. I mean, we could get a 10 bagger, a 50 bagger, and life would still be really good. But the studies that we're going to look at today looked at previous 100 baggers. So the price of any stock really has two components. It's the earnings per share and the price that we're willing to pay for each pound of those earnings, or what's more commonly known as the PE ratio. So these are what we call the twin engines of growth. The earnings per share and the price that we're willing to pay for those earnings, or the PE ratio. Now, why I said there could be the triple engines of growth is that we can actually break down EPS into earnings and the number of shares that have claims to those earnings. So if we can imagine the earnings being our pie, the numbers of shares is how many slices of that pie there are. The more slices, the smaller your slice is going to be. So all else being equal, we want the number of shares to go down over time. Now, to put this into a real life context, I've taken a company that's 100 bagger from exactly 20 years ago today that I think a lot of us might be familiar with here, which is JD Fashion. They run the sports clothing retailer, JD Sports. So let's look at how JD Sports became a 100 bagger over the last 20 years. And by the way, a 100 bagger in 20 years gives you a 25% annual return, which completely smashed the FTSE 100, which only gave a 4% return over the same time frame. So here we can see at the very top the earnings growth. So earnings went from 13 million to 697 million. That was a 53x over 20 years. Next, the number of shares grew 10% over that time. So this was actually a 10% headwind. And that led EPS to grow 48 times. Now, 48 times would have been a magnificent result. No one would have been unhappy with 48 times, but it isn't a 100 bagger. What you needed to have a 100 bagger was also growth in the price earnings ratio. The price earnings ratio went from about 5 to 10, a double. And that's how you got the 100 bagger. And so this is your twin engines of growth, and we're going to come back to this concept again and again. So you need the earnings to grow, but you also need the PE ratio to grow. So now I'm going to move on to the different studies of 100 baggers. And we're going to look at the lessons that those studies can teach us. The first of these studies was done by a man named Thomas Phelps, and he looked at all of the 100 baggers in the US between 1932 to 1972, so a 40-year period. Now, I've listed some of the companies up there because I think you'll find it surprising that even though this was done about 90 years ago, there's so many companies that we still recognize there. Pepsi, J&J, Caterpillar, Gillette, Deere. I mean, these are still great companies today. And so this is one of the truths, is that great companies tend to stay great companies. Of course, there's your Xeroxes and Eastman Kodaks that fell away. But great companies tend to have long lives. So Thomas Phelps really put the 100 baggers into 4 buckets. One way that we could get 100 baggers was by buying companies at really depressed prices. This is when there was real fear in the markets. But this wasn't the majority of stocks. This was only a few, and it really had some sort of element of market timing to it. And so this wasn't really a repeatable process. You couldn't just keep timing the bottoms. So yeah, this isn't really what we're looking for, is a repeatable process. The next 100 bagger was an extreme change in the supply-demand ratio. And what we're really talking about here is the commodity businesses. Now, the problem with these 100 baggers was that they often round-tripped. If you look at commodity businesses, they're very cyclical, and they go up 100 times and then they go back to 1. The third bucket was highly levered businesses. Leverage works both ways. It can give you great results, but it can also kill you quickly. And so when we look at the highly levered bucket, what we find is out of the whole population, there's a lot of zeros. This is a minefield of dead companies. And so again, this isn't really an attractive bucket of companies to look at. But the biggest bucket of all the different companies in the study were the great businesses that earned high returns on invested capital. And I'll explain a bit more about what that means. But I want to just point out a quote here from Thomas Phelps, again going back to our twin engines of growth. Most great advances in the stock market result from a combination of rising earnings and rising price-earnings ratio. Again, our twin engines of growth. So what did I mean when I talked about great businesses earn high returns on invested capital? Well, I'm going to show you this by looking at a very simple example. 3 factories. Each one of these factories cost £1 million. And this is the invested capital. So what does that mean? That means the factory building, that means all the machines, that means all the office space. So this is the invested capital. And the first business here we can see earns 10% return on invested capital. So that means in year 1, it's going to earn £100,000. But this is the great thing about businesses, is they can reinvest those profits and they can compound those profits over time. So in year 2, we see that 100,000 has been reinvested in the business and the earnings have grown to 110,000. And so what we see is really the magic of compounding happens more over time. By year 10, it's more than doubled its earnings. So let's go to the next business, factory 2. So we can see again it costs £1 million, that's the invested capital, but it earns 20% on its invested capital. So this is a better business. It earns more for the same capital invested. So in year 1, we get 200,000. So already double factory 1's profits. But the real magic happens by year 10. Those profits have been reinvested every year, and by year 10, it's now 4 times the first factory's earnings, And so we can see over time, better businesses that can reinvest their money grow exponentially faster than average businesses. Now, the last factor here is the same as factor 2. It costs 1 million, it earns 20% return on invested capital, but instead of reinvesting all of those profits, it's going to pay out 50% in a dividend. So we can see in year 1, both factory 2 and factory 3 earn 200,000. But then by year 2, we can see that already factory 3 is fallen behind in its profits because it's not reinvesting those profits, it's giving them back out to owners. And then what's remarkable is by year 10, the company that pays out the dividend has earnings of almost a third of the second factory. And so this is what Phelps says, is that dividends are an expensive luxury. And this is why. So what were some of the key lessons that Phelps wanted us to learn from the study? And I think there's so many great quotes in this book that I think he says it best himself. To make money in stocks, you must have the vision to see them, the courage to buy them, the patience to hold them, and the patience is the rarest of the three. So let's break this down a little. You must have the vision to see them. The majority of 100-baggers start off relatively small. And so we need to have the vision to see how these can grow into much bigger businesses. We need to have the imagination to see how a small business can grow into a much larger one. The courage to buy them. Often the best investment opportunities come when there's fear in the market. If people are talking about inflation, if people are talking about war, if people are talking about rising interest rates, none of this really matters to great businesses, but we need to have the courage to look past the noise and to buy these great businesses. And then finally, the patience to hold them. Great businesses compound over time. Like we look back to our factory example, the real magic of compounding happened in year 10, not in year 1 or 2. So as business owners, we want to hold our businesses for a long period of time. Go back to the statistic that the average investor only holds for 7 months. I mean, the business can't change over 7 months. Great businesses change over years. And all of the richest people in the world held great businesses for long periods of time. The second point, what one buys in the stock market is much more important than when he buys it. So what Phelps showed was that you didn't need to time the market to buy these great businesses and get a great result. Actually, what he showed was that the majority of these businesses could have been bought at 52-week highs and you still made a 100-bagger. And so what really comes from this study is, if we go back to our twin engines of growth, EPS and PE, over the long term, the EPS growth is the most important. Even for those who buy right, as Cinderella did, fine carriages turn to pumpkins if one stays too long. Now, what we mean by patience doesn't mean that we just buy a company and never sell. We need to be diligent business owners. We need to make sure that when we have a great business, it stays a great business. We need to make sure that we're holding on to the Pepsis, the Gillettes, and we're not stuck with the Xeroxes. And so as business owners, we need to be making sure that our business is still performing well. Finally, never, if you can help it, take investment action for a non-investment reason. And I think this is really important. I think a lot of investors jump in and out of stocks for non-investment reasons. They think the stock's too high now, let me lock in the 20% profit. Or they say, oh, there's going to be inflation, or there's going to be, or we have rising interest rates, let's sell. But none of this matters to the business. And so here, this is an example in Phelps' book. This is the earnings of Pfizer. And over this time, Pfizer became a 100-bagger, and yet almost no investor held on from 1951 to 1970. And if we looked at the earnings here, we can see almost every year share earnings grow, dividends grow, the sales per share grow, book value grows, and return on equity stays high. Business-focused investors had no reason to sell. It was only investors who were focused on non-investment reasons to sell that sold. And so this is one of the lessons that we take from Phelps, is that focus on the business. Take investment action for investment reasons. The next study was done by Chris Mayer, and he picked off where Phelps left off, which was, he looked at all of the 100-baggers in the US from 1964 to 2014. And really he found the same lessons. So what I want to do this time is just go through some of the companies in the study. So here we can see, these were the companies in the study that gave investors the best return. And no surprise, at the top is Berkshire Hathaway, Warren Buffett's company, an 18,000-bagger. For every £1 invested in Berkshire Hathaway, investors got back 18,000 over this 14-year period. And one thing that I think that's really interesting in looking at these companies is that a lot of investors might think to get the really big returns, we need to bet on some new technology or some better product. But that really isn't the case. Look at the companies that are up here. Kansas City Southern, they're a railway company. Altria, they own Marlboro cigarettes. Walmart, TJX companies, is you might know them as TK Maxx. Southwest Airlines, an airline business, a notoriously terrible business, yet it 100-bagged in 9 years. Great businesses can be found everywhere. Don't bet on new technologies or fads. Bet on great businesses, stay in great businesses. And so you might ask, okay, but they were the best returners, but what about the fastest 100-baggers? Surely that was just full of tech companies. And yet again, you'd be wrong. We do see more tech companies and we see more pharmaceuticals, but that isn't the majority of them. They're 100-baggers, and the quickest 100-baggers could still be found everywhere. The number one, the fastest 100-bagger, just took 4 years. Franklin Resources, they're an investment manager. We also have NBR at the bottom there. They build residential real estate. We have Hasbro in there, a toy maker. We have Monster Beverage Corp, maker of energy drinks. And so what these have in common is not that they had some new technology or they had some new magical product. They were great businesses that stayed great businesses. Monster Beverage is still a great business today. And many of these companies that we can still see here are still great businesses. One of the things that we take from all of these studies is that you need patience. You need patience to really realize the great returns that these great businesses provide shareholders. So the average length of a 100-bagger in this study was about 20 to 25 years. So to get the 100-bagger, you need to have held on for, and most of the, well, at least 4 years, which was the quickest, but on average, 20 to 25 years. Now let's go back to the average holding in the share market as a whole, 7 months. I mean, it's crazy to think that you're going to be able to hold on or get a great return from a great business in 7 months. The average was 20 to 25 years to really realize the great returns. Now you might say, oh, I don't want to wait that long, like it just seems forever and it's not going to be that good a return over that time. Well, here, let's say if it's a 100-bagger in 30 years. So that's on average a 16.6% return. Now let's compare this 30-year 100-bagger to the S&P 500. So the S&P 500 has delivered an on average 10% return a year, and that's a great result. Far higher than the FTSE that's delivered 4%, and many other stock markets that haven't even delivered positive returns over the last 30 years. So you might think that an extra 6.6% return a year isn't that much, but over time, the compounding makes it a huge difference. We can see by year 10, the 100 bagger is now almost double the S&P 500, not quite, but the real magic then happens in year 30. The 100 bagger has turned 10,000 into 1 million, whereas the S&P has turned 10,000 into 174,000, a 17x. Again, 17x is not bad over 30 years, but it's not a 100 bagger. And the difference is huge. So if you really want the big outsized returns, you need to be patient. You need to hold the great companies for long periods of time. So what were some of the common characteristics in Chris Mayer's 100 baggers? For one, the average company was small. The average company in the study had a $300 million market cap and an average sales of 170,000. And this is because it's just much easier to grow when you're small. For example, Amazon, Google, they're great businesses, no doubt. But are they going to grow 100 times from here? I mean, they're already a $3 trillion market cap. Can they really be a $300 trillion market cap? I don't think so. And so when we're looking for the great long-term returns, we need to look small. We need to have that runway of growth. The vast majority of the businesses in the study started profitably. And this is one truth, is that most great businesses start profitable. Not all, you're always going to get your Amazons that slip through, but when we've got 10,000 stocks to potentially look at, we want to get a net that filters out some of those companies and narrows the field and gives us a better chance to find a 100 bagger. And so one of those is look for profitable companies. Great companies tend to start profitable. Low multiples required. So again, this goes back to our twin engines of growth. That really, to get the best results, we need both of those engines working in our favor. The PE multiple growth and the earnings growth. But look, he says low multiples preferred. Really, the most important thing was the earnings growth. Over the long period of time, the earnings growth is going to do the heavy lifting. And finally, the most important one goes back to our factories. High returns of capital, but most importantly, the ability to reinvest those profits. So think about the difference between the factory that paid a dividend and the one that didn't. It's about the reinvestment of those profits. Now, I'm going to quickly talk about a study done in India by Motilal Oswal. And they've done a number of studies on what they call wealth creators in India. This particular one I've chosen is the fastest wealth creators from 1995 to 2020. And you think 1995 to 2020, yet again you must think it's all going to be tech stocks. But you would be wrong. Up at the top we have Infosys, which was an IT consulting business, so a consulting business. We see on here we've got 2 cement companies, we've got 2 paint companies, we've got banks, and we've even got a cake maker who makes biscuits. You could find great businesses everywhere. They didn't have to be a bet on some new technology, and I know I'm repeating myself here, but it was a bet on great businesses staying great. And I think this chart does a really good job of laying out what does it mean to, or what do you need to get a 100 bagger or a great result. So first of all, we look at the return on equity. You look, even in 1995 when this started, all of them were profitable. Every single one of these companies was profitable and already earning a high return on its equity. If we look at the PE ratios, they tended to go up, but not always. And then the real driver of growth was the profit, the growth in profits. We can see in 1995 on the market cap that these companies all started small. The biggest company there was Asian Paints with 11 billion, with a market cap of 11 billion rupees. That's only about 100 million pounds. And so these companies all started small. And so they had that long runway of growth. I think emphasis here, we can maybe take it as an example of how did the twin engines of growth here apply to emphasis. So in 1995 it had a PE of 26, and by 2020 it had a PE of 17. So you actually had a headwind in the PE. So here the PE was a headwind. But the profit growth was 33% a year. And that gave investors a 30% yearly return. And so we can see over the long term, it's the earnings growth that's going to do most of the heavy lifting. Motilal Oswald has a framework for finding the wealth creators. They say you need to have a good quality business and quality management. Management isn't something we've talked about so far. So we are owners of the business, but we're not the operational partner. We're not involved day to day. Management is. They're what's called our operational partner. So we need to partner with great management teams that we can trust. Good quality businesses, we need to invest in good quality businesses that can compound and reinvest their profits. Growth in earnings. Again, going back to our twin engines of growth, it's going to be the growth in earnings that are going to give you the real outsized returns. Longevity and growth. This is where it helps to be small. You're going to have that long growth runway. But there's also more to this. Longevity, think about what happens over any 10-year period. There's wars, there's financial crisis. Your business needs to be able to survive this. And so that means having products that people buy even in a downturn. It means having good balance sheets that can survive a downturn or higher interest rates. And finally, price. You needed to pay a reasonable price. And again, the earnings are going to do most of the work, but you don't want to overpay for companies. And what I thought might be interesting is to look at the best performing stocks in the US market. So in India, we've seen some of the best companies were cement companies and paint companies. And you might think that in the US, it would all be tech. But yet again, you'd be wrong. In the US, we see names that we would expect: Amazon, Apple, Nvidia. But look at the top. The best performing stock in America has been Monster Beverage. They didn't reinvent the wheel. They just had a great product, great marketing that people wanted to buy. You see NVR up there, the 6th best stock to buy in America. And what do? They build houses. You have Pool Corp, they build residential pools. And you can go through this list, and what you find is that these were just great businesses. You didn't need to bet, largely you didn't need to bet on a new technology or new product. So the last study I want to talk about is the making of a multi-bagger by Alta Fox. Now this one's a little different. So previously, the last 3 studies we looked at were over long periods of time. The making of a multi-bagger was done just over 5 years, from 2015 to 2020. What they did was they looked at what were the best performing stocks over that 5-year period around the whole world. So this time not just in America. What they found was that the multi-baggers could be found in any country. Yeah, okay, the US had almost 29% of the multi-baggers, but this means it was actually underrepresented. The US stock market accounts for almost 50% of all of the world's stocks. So the US was actually drastically underrepresented. And why was that? Because it's the popular place to be. You want to go where the fish are, not where the fishermen are. Industry breakdown, again, as we would expect, 2015 to 2020, a large percentage of technology stocks. But they could also have been found in any other industry. There was multi-baggers over a short period of time in all industries. And again, it was about betting on great businesses. So as we can see, over 5 years, the multiple expansion, that PE growth, does much more of the lifting. Over a 5-year period, multiple expansion accounted for 65% of the growth in the total shareholder return. So if we're looking for quicker profits, we need to focus on buying the company cheaply. And then longer term, it's going to be the growth in earnings that does most of the heavy lifting. So out of the businesses in this study, 91% had clear competitive advantages. Capitalism is brutal. If you've got high profits, other companies are going to want to come and take those profits. You need to have something that's going to protect your business from the competition. That can be a great brand, it can be a new technology, it can be patents. You need to think about how is this business going to protect its profits from the competitors. 42 of the multi-baggers had operated in industries with high barriers to entry. What does that mean? That means like regulatory barriers. Think about the medical industry. It's really hard to enter the medical industry, there's so much regulation. 84% of the companies had a market cap below 2 billion. Again, the vast majority of the multi-baggers were small. These were not your Amazons or your Nvidias. These were small businesses that had long runways of growth. Only 14% of the companies in this study started unprofitable, and only one ended the study unprofitable. And this goes back to, again, the great businesses usually start profitable. I think I didn't mention, but in the study, the multi-baggers had an average of a 900% return versus only 55 for the S&P over the period of the study. Okay, so as we talked about the studies of the 100 baggers and some of the lessons we can learn, but what about actually how to implement this into our own portfolio? And what I'm going to do is I'm going to show you 3 different ways professional investors have implemented the 100 baggers into their own portfolio. And this is by no means the only ways to do it, but it's just to give you some ideas. So the first way I'm going to talk about is called the coffee can portfolio. This was an idea that was first thought up by a guy called Robert Kirby after he heard a story. He had this friend, a financial advisor, that had been advising this woman on what stocks to buy. And every now and again he would buy and sell stocks for this woman and manage her portfolio. But what he didn't know was the husband was piggybacking onto these ideas. Every time the wife had a new stock in the portfolio, the husband would buy $5,000 of that stock. One day the woman goes to the financial advisor, "My husband has sadly died, can you also manage his portfolio?" And what the financial advisor seen shocked him. The husband's portfolio had grown many times faster than the wife's. Why? Because the husband just held on to these stocks. When you looked into the husband's portfolio, what did you find? You found a few stocks had gone to zero. You've seen the majority of stocks had performed on average like the market. But a couple of stocks had become 100 baggers. There was even one 800 bagger in there. And that really drove the outperformance. It was these small percentage of stocks that became the 100 baggers. And so this idea of the coffee can comes from cowboys in the Wild West. They would often store their valuable possessions into a little coffee can and hide it somewhere. And then come back in the future and hopefully the things inside the coffee can had increased in value. And so we can implement this in our own portfolios. We can make a portfolio of stocks that we think they're going to do well over the long term, and then we just don't look at it. We give ourselves, let's say, 10, 20 years, and then we go back into our coffee can and look at what's happened. This might mean giving your brokerage password to a trusted friend or family member. So you force yourself not to trade and not to have that call to action that the market gives us. And if you want to learn more about the coffee can method of investing, there's a great book by Sarah Mukherjee called Coffee Can Investing. The next way I want to talk about is the motley fool way of investing. So I would say this is very much the same as a venture capital approach. They're completely business focused. They don't care about the stock or what the macro economy is doing. They're completely focused on the business. They have a portfolio of hundreds of fast-growing businesses. They take small positions in many, many different fast-growing companies. But they let their winners run. They don't sell their businesses when they get very big. So actually the motley fool portfolios are quite concentrated now. Some of their 100 baggers have been Amazon, Netflix, and a lot of other companies you would know. And these are now the biggest positions in the portfolio, even though they started off as maybe only a 0.5% position. And so this is like a venture capital approach, is that you're just going to take 100 stocks or so, and you're going to know that maybe 10% are going to go to zero. The vast majority are going to perform the same as the market, but it's going to be your outliers, the 1-2% of those companies that become 100 baggers that are going to drive the return. The motley fool are very lenient on valuation. It's not that they don't care about valuation, but they know over time in our twin engines of growth, it's the earnings growth that really does the heavy lifting. And again, there's a book there if you want to learn more about the motley fool way of investing. There's a book by the two founders. The last way that I want to talk about is the Charlie Munger way. And this is Warren Buffett's famous partner at Berkshire Hathaway. What he does is he runs a very concentrated portfolio. Over his career, he's sometimes only had 1, 2, or 3 stocks. And he will only own the very greatest businesses. And he waits until he sees a very clear opportunity, a no-brainer as he would call it, and then he swings hard. He goes all in. And this is his current portfolio. We can see Berkshire Hathaway and Costco make up more than 50% of his portfolio. He's very concentrated. But these are great businesses, and he knows they're going to stay great. So the sort of 4 key tenets I take away from Munger's portfolios is extreme patience. He waits and he waits and he waits. He can go years without ever buying or selling anything. And that's like a good business owner. That's what a business owner would do. He only buys the greatest businesses. He doesn't bet on a bad business getting better. He buys businesses that are already great. And it's a bet on them staying great. He buys businesses he truly understands. As investors, we often trick ourselves that we can understand every business. And this just isn't true. There's so many businesses that I personally look at and I have no clue what they do. If you can't understand the business, just leave it. There's so many businesses out there. And again, concentrate on your best ideas. Munger always says, why would you put money into your 20th best idea when you can put more money into your best idea? So concentrate on your best ideas. And again, Munger is one of the most written about investors out there. There's loads of books. These 4 I think are particularly good. So if you want to learn more about Charlie Munger and the way he invests, these are the books to read. So what are the key takeaways from this? So I think the number 1 takeaway is that we have to think and act like business owners. When we buy a share, we're buying the partial ownership in a business. And I think if you get that right, so much else falls into place. Buy right. Buy the right company at the right price. That means a high quality company that's going to grow over time and it can reinvest its capital. At the right price, again, we want the twin engines of growth working for us. The PE growth and the earnings growth. We need both of those working for us. Sit tight. You're gonna have to be patient. Businesses don't change overnight. Businesses compound wealth over many years. And as business owners, we have to let those businesses grow and give them some leeway. The last one is construct a portfolio that suits you. The reason why I chose those 3 portfolios was not because they were the best, just because they were very different. And I think it shows you that there's many ways that you can implement these findings, but you have to find the one that suits you and that's going to allow you to hold these companies. And most importantly, that's going to allow you to sleep well at night. Not everyone is going to be comfortable like Munger, only holding 1 or 2 stocks. So you have to find the right portfolio for you. Yeah, so that's everything I have to say. Used to write a blog and still might, but you can look on there that you can see how that I value businesses. I've also written a short book on compounders, and you can have a look. And if you're interested in finding the great businesses, I've written some stuff about that, and it's all free. Right now I'm not writing because I'm too busy with work, but I might go back to it. And there's the company I work for. We're a Swiss family office called Anchor Capital, and if you want to find out more, there's the link. I'm going to send out this presentation if anyone's interested. I'll put some links to learning materials and different websites for anyone that's interested. So thank you very much for listening.